Have you ever wondered why some people build lasting wealth while others, despite earning more, always seem to struggle? Why do smart, educated professionals make terrible financial decisions? And why does someone with average income sometimes retire comfortably while high earners live paycheck to paycheck? The answer isn't found in spreadsheets or investment strategies. It's hidden in something far more powerful: the psychology behind every dollar you earn, spend, and save. Most of us were never taught that money is deeply emotional. We treat it like math, but it behaves like psychology. And that gap between what we think we should do and what we actually do determines everything. If you've ever felt confused about why your financial progress feels slower than expected, or why certain money decisions haunt you later, this is for you. Today, we're exploring timeless lessons that will change how you think about wealth, risk, and success forever. Morgan Housel's insights have resonated with millions of entrepreneurs, investors, and professionals worldwide because they cut through the noise. This isn't about get-rich-quick schemes or complex formulas. It's about understanding the invisible forces that shape every financial decision you make. In a world obsessed with tactics and hacks, Housel brings us back to what actually matters: behavior, patience, and perspective. His work is especially relevant now, in an era of constant comparison, instant gratification, and overwhelming financial advice. Whether you're building a startup, managing a career, climbing out of debt, or investing for the future, these principles apply universally. What makes this perspective so valuable is its focus on sustainability. It's not about timing the market perfectly or finding secret opportunities. It's about building a financial life you can actually maintain for decades. Because wealth isn't just about getting money, it's about keeping it, growing it slowly, and avoiding the psychological traps that destroy it. By the end of this, you'll see money through a completely different lens, one that prioritizes long-term thinking, emotional discipline, and realistic expectations. Let's begin with one of the most misunderstood aspects of wealth: luck and risk. We live in a world that loves to credit success entirely to skill and blame failure entirely on poor decisions. But the reality is far more nuanced. Luck and risk are two sides of the same coin, and they play a much larger role in financial outcomes than we're comfortable admitting. Think about it. Some of the wealthiest people alive were born in the right place at the right time, with access to opportunities most people never see. That doesn't diminish their hard work, but it's incomplete to ignore the role of circumstance. On the flip side, people lose everything through no fault of their own, through illness, economic collapse, or bad timing. The lesson here isn't to downplay effort or skill. It's to recognize that outcomes are rarely as simple as they appear. When you see someone succeeding, resist the urge to reverse engineer their success into a formula. When you see someone struggling, resist the urge to assume they made all the wrong choices. This mindset is critical for entrepreneurs and investors because it teaches humility and patience. You stop chasing every shiny opportunity just because someone else struck gold. You stop beating yourself up when things don't go as planned despite your best efforts. Instead, you focus on controlling what you can control: your behavior, your consistency, and your response to uncertainty. Modern examples are everywhere. A startup founder launches at the perfect moment when market demand explodes. That's luck meeting preparation. Another founder with an equally great idea launches during an economic downturn and struggles for years. That's risk. Neither outcome tells the full story. Understanding this prevents you from making reckless decisions based on someone else's highlight reel, and it keeps you grounded when your own path feels slower than expected.
Now let's talk about enough. This might be the most underrated concept in all of personal finance and business. The idea of enough is simple but profound: knowing when to stop moving the goalposts. Too many people spend their entire lives chasing more, only to realize they sacrificed everything that mattered along the way. The trap is insidious because our culture glorifies endless ambition. There's always a bigger house, a more prestigious title, a larger investment return. Social media amplifies this by constantly showing us people who have more, and so we keep pushing, thinking that the next milestone will finally bring satisfaction. But it never does, because we never defined what enough looks like. This plays out in business and investing constantly. An entrepreneur builds a profitable company but risks everything trying to scale too fast because a competitor raised more funding. An investor earns solid returns but gambles it away chasing higher yields. A professional climbs the corporate ladder but sacrifices health and relationships in the process. The antidote is honest self-reflection. What does financial security actually look like for you? What level of wealth allows you to live comfortably, take care of your family, and sleep peacefully at night? Once you define that, you can build toward it without constantly moving the target. This doesn't mean settling or killing ambition. It means recognizing that the game changes once you have enough. Beyond that point, protecting what you've built becomes more important than accumulating more. Many of the wealthiest people who lost everything did so because they didn't know when to stop. They had enough, but kept playing as if they had nothing. Today, with endless content pushing hustle culture and extreme wealth, defining your enough is an act of financial self-defense. It allows you to play your own game, at your own pace, with your own definition of success. Compounding is often called the eighth wonder of the world, but most people misunderstand it entirely. They think it's just about investment returns, but compounding applies to nearly everything: skills, relationships, reputation, and yes, money. The real power of compounding isn't in the rate of growth, it's in the time you give it to work. A small edge, maintained consistently over decades, creates results that seem impossible in the short term. But here's the problem: compounding is boring. It requires patience in a world that rewards speed. It demands discipline when everyone around you is chasing quick wins. And it operates invisibly for years before the results become obvious. This is why so many people abandon strategies that would have made them wealthy if they just stayed the course. Think about someone who starts investing small amounts in their 20s versus someone who waits until their 40s. The difference isn't just 10 or 20 years, it's exponential, because those early years are doing the heavy lifting through compound growth. The same applies to building a business. Consistent effort, learning from mistakes, refining your craft year after year, this compounds into expertise and reputation that can't be bought or faked. Freelancers who deliver quality work build referral networks that generate opportunities for decades. Professionals who invest in relationships create compounding social capital. But compounding also works in reverse. Bad habits compound. Debt compounds. Negative reputation compounds. Small, poor decisions, repeated consistently, create mounting consequences that become harder to escape. The modern takeaway is this: stop looking for shortcuts. Start thinking in decades, not days. Whether you're building wealth, a career, or a business, ask yourself what small, sustainable actions you can repeat for the next 10 or 20 years. That's where real transformation happens, not in viral moments or lottery ticket bets, but in the silent, invisible accumulation of tiny advantages over time.
Now, let's shift to wealth versus being rich, because these are not the same thing, and confusing them leads to financial disaster. Being rich is about current income. It's the salary, the bonuses, the revenue numbers. Wealth, on the other hand, is what you don't see. It's the money saved, invested, and compounding quietly in the background. It's financial flexibility and freedom. You can be rich and broke, earning a fortune but spending it all, living with zero margin for error. You can also be wealthy on a modest income by consistently saving and investing over time. The difference is control. Rich people are often trapped by their lifestyle. They earn more, but they also spend more, locked into expensive commitments that require them to keep earning at the same level forever. Wealthy people have options. They can take risks, walk away from bad situations, weather downturns, and make decisions based on what they want, not what they need. For entrepreneurs and professionals, this distinction is critical. Many people optimize for appearing successful instead of actually building security. They upgrade their lifestyle with every raise, buy things to signal status, and end up on a treadmill they can't escape. Meanwhile, the truly wealthy are often invisible. They drive normal cars, live in modest homes, and quietly accumulate assets that generate passive income and long-term security. The modern trap is social media. Platforms are filled with people showing off rich lifestyles, exotic trips, luxury brands, but you have no idea what's happening behind the scenes. They might be drowning in debt, one bad month away from collapse. The lesson is to prioritize building wealth over looking rich. This means living below your means even when you can afford more. It means directing raises and windfalls towards savings and investments instead of lifestyle inflation. It means valuing financial independence over impressing people who don't care about your long-term well-being. Wealth is what gives you time, options, and peace of mind. Being rich just gives you stuff. Now let's address the concept of room for error, which might be the most important principle for surviving volatile markets, uncertain economies, and unpredictable careers. Room for error is your financial margin of safety. It's the buffer that allows you to survive when things don't go as planned, and they rarely do. Most people plan for the best-case scenario. They assume steady income, consistent returns, and predictable expenses. Then life happens. A recession hits, a business slows down, an unexpected expense emerges, health issues arise, and suddenly the optimistic plan falls apart. Room for error means planning for the worst while hoping for the best. It's saving more than you think you need. It's investing conservatively enough that a market crash doesn't destroy you. It's keeping cash reserves even when it feels inefficient. It's not over-leveraging your business or personal finances, betting everything on one outcome. In the startup world, room for error is the difference between companies that survive rough patches and those that collapse at the first sign of trouble. The business with 6 months of runway can pivot when needed. The one living month to month has no flexibility. The same applies to personal finance. Individuals with emergency funds can handle job loss without panic. Those living paycheck to paycheck are one setback away from crisis. Here's the deeper insight. Room for error allows you to stay in the game long enough for compounding and luck to work in your favor. Aggressive strategies might work in perfect conditions, but perfect conditions never last. The world is unpredictable, and the people who thrive long-term are those who build cushions into every decision. Modern professionals and entrepreneurs should embrace this fully. Don't maximize leverage just because you can. Don't spend every dollar you earn. Don't structure your life in a way that requires everything to go right. Build slack into your finances, your schedule, and your commitments. That slack is what keeps you sane, stable, and positioned to seize opportunities when they arise.
One of the most painful lessons people learn too late is that financial goals change over time, but long-term strategies often don't account for this. We make plans in our 20s that don't fit our 40s. We invest based on what we want today without considering who we'll become in the future. The challenge is that we're terrible at predicting our future selves. Young professionals sacrifice everything for career advancement, only to realize later they value time with family more than job titles. Entrepreneurs take extreme risks assuming they'll always have the energy and appetite for volatility, then find themselves exhausted and craving stability. Investors chase high returns without considering that their risk tolerance will shift as they age. The solution isn't to avoid long-term planning. It's to build flexibility into your financial life so you can adapt as circumstances and priorities change. This means avoiding irreversible decisions whenever possible. Buying a massive house with a huge mortgage locks you into a specific income level for decades. Renting or buying conservatively gives you freedom to adapt. Investing in low-cost, diversified funds allows you to adjust over time without catastrophic losses. Overcommitting to a single business or investment makes pivoting painful. This principle extends to career and business decisions too. Taking a high-paying job that destroys your health or relationships might seem worth it now, but will it in 10 years? Building a business that demands every waking hour might feel exciting today, but is it sustainable when your priorities shift? The key is honest reflection about what you actually value, not what you think you should value. Then structure your financial and professional life to protect those values as they evolve. Modern life moves fast, and the ability to adapt is more valuable than perfect optimization. Stay flexible, avoid overcommitting, and give yourself permission to change course as you grow. Finally, let's bring this all together. The overarching lesson is that financial success isn't about intelligence, education, or even income level. It's about behavior. It's about managing fear and greed. It's about patience and consistency. It's about defining success on your own terms and protecting it once you achieve it. Every principle we've discussed returns to the same foundation: understanding yourself and the psychological forces that influence money decisions. Wealth isn't built by those who know the most. It's built by those who behave the best over time. Those who can delay gratification, stay disciplined during booms, remain calm during crashes, and think in decades rather than days. The modern economy makes this harder than ever. We're bombarded with financial noise, comparison traps, and pressure to optimize every decision. But the fundamentals remain unchanged. Spend less than you earn, save consistently, invest for the long term, avoid unnecessary risks, build room for error, know when you have enough. These aren't sexy or revolutionary, but they work. They've worked for generations, and they'll continue working because they're rooted in human psychology and the mathematics of compounding. If you take one thing from this, let it be this: your financial life is a marathon, not a sprint. The decisions you make today will echo for decades. Choose behaviors you can sustain. Build wealth you can keep. Define success in a way that lets you sleep peacefully. And never, ever let someone else's path distract you from walking your own. Because at the end of the day, the greatest wealth is control over your time, peace of mind, and the freedom to live life on your terms. That's not about hitting a number in your bank account. It's about building a financial life that supports the life you actually want to live. And that's a goal worth pursuing, slowly, patiently, and with intention.